Good morning, everyone, and welcome to the craft stage here at the very first Finance Magnates Singapore Summit. I'm going to try in Chinese as well for the rest of you. 早上好，欢迎来到 Finance Magnates 新加坡分会的 craft 舞台。I'm Dushka, and I will be hosting today's conversation with some of the builders, operators, investors, and market leaders shaping the future of trading, fintech, and financial infrastructure across Asia. Let's get started. We're opening today with a conversation that sits at the core of Singapore's financial identity, capital formation and exit opportunities. Singapore is often viewed as a safe and stable financial hub, but behind that reputation is a sophisticated ecosystem connecting venture capital, institutional finance, family officers, public markets, and increasingly alternative liquidity pathways. This session, held in the partnership with 8 Circle, brings together voices from the venture capital, investment banking, and public markets to examine how founders and investors can navigate the full life cycle, from early stage funding all the way to exit. Please join me in welcoming our moderator, Vidushan, founder of the 8 Circle and the Tech Lab. The stage is yours.
Yeah. Hi, everyone. Thank you, Natasha, as well. Thank you for being here. So during this session, which will cover about 40 minutes, we will quickly go through why Singapore is an attractive financial hub, drawing large pools of VC, startups, acquirers to this country, whether due to its forward-looking regulations, forward-thinking, access to global markets, etc. We got an amazing panel here joining us. So before we start with the content, I'll just give each panelist 30 seconds to give a quick intro about themselves. We'll start with Tom.
Thanks, Vidushan. Morning, everybody. My name is Tom Abbott. Work for the London Stock Exchange, but based in Singapore. Speak to companies from across the Asia Pacific that might want to access the deeper pools of liquidity and capital in London, meeting their shareholders and so on, but also spend some of my time. About 10% of the companies listed in London are from the Asia Pacific, so I also spend some of my time speaking to them and making sure that they're happy on market and know how to interact with their investors.
Hi everyone, good morning. My name is Luca from Illuminate Financial. We're a specialist early stage investor focused on enterprise AI and fintech, headquartered in London, office in New York, and one here in Singapore. And we're backed by many of the large financial institutions. So we have JP Morgan, Citi, HSBC, Deutsche Börse, and SGX amongst our LP base. So very focused on the sector and investing in early stage companies here.
Yeah, so my name is Zong, partner at Cocoon Capital. We are pre-seed and seed stage focused VC. We're based in Singapore. We invest across the region. And we do very targeted investments into a slightly smaller portfolio company and help them scale upwards into the Series A and beyond.
Awesome, guys. So I'll start off with Luca. So as you've seen, you've been an investor through Illuminate Financial and so on. So many startups actually pick Singapore as one of the places to launch. So in terms of opportunities and challenges, what are those that you see for a startup setting up, say, in Singapore or compared to, say, Europe or US?
Yeah, so I mean, we have a pretty interesting seat in that we invest globally, right? So we invest in the US, in Europe, and here in Singapore and Hong Kong. And there's a lot of reasons why someone might choose to set up a company here in Singapore. Obviously, very friendly legal and regulatory regime. There's a pretty deep talent pool, which is always important, and then a fairly deep capital pool for particularly early stage financing. I think we do have to take that into context, though, in that if you look at venture dollars raised in Q1 this year in SF, you're talking about 170 to 180 billion dollars. Here in Singapore, 2 to 3 billion, right? So we're still a very, very small market compared to what's raised in the US. So I think if you are choosing to start here, you have to think about what are the key kind of levers that you can pull here that would make a company successful either regionally or globally. So I think if you are focused on, obviously, Southeast Asia, it makes a lot of sense to be here. If you are building globally, what are the key either talent unlocks that you can unlock here that you might not be able to do in the US at the same price points, or you're looking at what are the capital pools that, again, or kind of support structures that you have available here through, I mean, partially also various government initiatives, but also some very specialized early stage investors that can help you get off the ground. But I think you have to remember and recognize that the journey is going to be very, very different if you start here versus in SF particularly, but also New York or London, in that the risk capital that is available is of a very different flavor. So you're going to have, firstly, more capital available that is more comfortable with kind of venture-skewed bets, particularly in San Francisco, but also in other parts of the US. So when you're setting up a company here, you want to look at how, what can you do with likely the smaller amount of capital that you raise. And maybe it's thinking about getting to profitability sooner. Maybe it's considering very lean, a very kind of lean structure to begin with, because it's going to be difficult to go out and raise the type of seed rounds that you see advertised in the US. It's going to be difficult to raise 20, 30 million from the get-go. You might raise 2 or 3. So very, very important as you're thinking about setting up here to recognize both those opportunities and differences between the regions.
Yeah, that's great. So I'll just move to Zong now. So let's look at it from an investor's angle here. So one of the biggest, I would say, fiduciary responsibilities or concerns that might have mainly for your LPs and so on is the failure risk. So how do you mitigate that for potential LPs or investors that actually invest in, say, your fund? And you guys are, I would say, one of the few that are around who lead around as well. So from that angle coming in, how do you literally navigate that failure risk that one would have?
Yeah, so I think I completely agree with everything that's mentioned so far. I think, and looking at it more from the investor lens. So the interesting thing about Cocoon is that a lot of our LPs are also active direct investors. So they leverage us for deal flow as well. And what we do in terms of setting up the companies for success, obviously, is no matter how hard it is to have a parent-subsidiary relationship across Southeast Asia, we make that happen when we lead the seed rounds. So we put a lot of time and effort into the legal paperwork. And at the same time, it is not just about setting up that sort of relationship, but also making sure the founders are employed by the Singapore company, the IP is held by the Singapore company. In essence, you can see where I'm getting. There has to be as much value as possible housed in a safer region. Or more predictable region as well, so that by the time we go and raise money in the US or in Europe, I would say meeting the standards of due diligence and also making sure that foreign investors will be satisfied with the level of corporate governance there is something of a, I would say, key milestone that we tend to try and get our startups to hit if they're going global. So that said, I think by employing a lot of this at the early stage where we as the lead investor can dictate the investment structure, that is how we try and set up our startups for success, and also at the same time provide a more, I would say, holistic environment for not just later stage funds, but also individual LPs of ours who are looking to make direct investments, who may not even be based in the region. So those are all the things that we have in consideration, especially when we lead the round and sort of set up the paperwork.
Awesome. So Tom, let's talk a bit about exit. So London is one of the nice hotspots where Singaporean businesses that are growing, scaling, can actually look at, I would say, more access to funding and so on. So in terms of an exit, where does London stand? And I heard that you guys are also launching a private market exchange as well. Could you explain a bit about that?
Sure, thank you. Look, I think the important thing to say in my role is I'm not here trying to drag companies kicking and screaming over to London. It has to make sense from a strategic point of view. And whether that be from a sector that's well understood in London, be it from expansion plans, be it from acquisition targets in a certain region, not just in the UK, but we're also quite strong across Europe, Africa, Middle East, as well as even going into the States as well. Having that sort of perspective, we're also trying to be, as an exchange group, agnostic as to whether a company is public or private. Quite a grand thing to say, but instead of just being able to say, hey, come and list in London, here's why, liquidity, depth, etc., we want to be having those conversations where private companies staying private for longer, a lot globally, needing to scale up, needing to make sure they've got all of those standards and so on in place. Can we provide a platform for them to do what we've always done as an exchange, which is for companies to meet investors, as simple as that. So we've launched a new private secondaries platform. It might be that opportunity to have your first engagement with some of the larger institutional names in the US and the UK. We are trying to do it differently than some of the other private platforms out there in that the company keeps control of that process. You can set a bandwidth in terms of that pricing as long as you disclose the methodology, but very much still a private company up in terms of disclosure as opposed to public company down, and very much a buyer beware market. So we launched that just this year, one transaction so far with 2 to come in June, but hopefully provides that sort of funding continuum. You go from some of that early stage investors, maybe you just need to work away, stay private for longer, keep on getting that path to profitability. Maybe you do need to help some of your early stage employees and investors out and have that liquidity moment, or maybe look at, hey, actually public markets is the way to go, and so on. So we're just trying to provide that flexibility in London.
Okay, awesome. So there's a lot of talk about these days around dual listings. So could you just explain, where does it make sense to actually do a dual listing?
I think with dual listings, as well as a sole listing, in some ways it still has to have that strategic rationale. We have a dual listing today, which is coming from Uzbekistan. The Uzbek National Investment Fund is listing their fund in London today. The reason they're doing that is the Uzbek market is tiny. They really do need the depth of capital that there is in London. And we also have a lot of emerging market investors that have their bases in London. If I'm honest, might be agnostic as to which exchange it goes on, but understand a listing in London, the corporate governance around that, and so on. At the other end of the spectrum, we've had a business from Singapore, which was in the gaming sector, something that's really well understood in London, and they were looking to make acquisitions in the market, in the US in particular, and they thought that was a nice stepping stone. It's quite a small mid-cap story that would have got lost in the US. But via London, sector well understood. They've had a bump of about 5 times the liquidity since they did that dual listing in London. And again, at the other end, we had a mining story from Canada. It's resources are also well understood in London. So I think there has to be that strategic rationale. It shouldn't necessarily just be about brand awareness, or you always wanted to go to that market. You've got to consider the costs that come alongside it. London. We've done a lot of work around our rule set over the past few years. I know everyone is, SGX are as well. We've always been welcome. We don't have recognized exchanges or anything like this. You just have to be an IOSCO member exchange, and we'll recognize that underlying listing. Always been quite accessible. So I think as long as you have that strategic rationale and want to raise capital, I think some people will just do it as a sort of flagging we're there and might raise capital later. I think that's where you don't necessarily get the results you wanted and actually just add a lot of cost. So something you have to think through and really make sure that market is for you, but equally something you'd have to do with that first listing as well.
And which stage do you recommend, like looking at a dual listing or say an overseas market like London?
Stage. I think there's 2 routes. I think it can make sense to do it with the Uzbek one. This is a concurrent dual listing. You're seeding liquidity in both markets. You're keeping domestic shareholders happy as well as reaching out to the more international institutional base. So I think that concurrent one can work, but typically for more sizable companies. Again, it then becomes around that. Are you looking at a specific acquisition in that you need that currency raising in that market? Are you expanding into that country? Has your revenue base shifted over the years? So I think it really is a case-by-case business, but just needs that strategic rationale.
Awesome. So Luca, let's get specific now into, say, fintech investments there. So what makes, what are the key drivers that Singapore has in drawing more fintech investments or encouraging foreign companies to set up here or fintech companies to set up here? What would actually drive them, and what are the key attributes to note of in raising?
Yeah, we focus on B2B companies. So there's obviously a differentiation between whether you're building here for a retail market and then also considering nearby economies where there is a lot of demographic tailwinds and digitization occurring. So a lot of the fintech bets that have been made here over the last 5 to 10 years have kind of followed that thread. If we look at the more institutional side, obviously the MAS has given relatively clear guidance over the years around particularly the digital asset space, what is allowed, what isn't allowed, and they've been a front runner in that sector, I think, globally. So we've seen a lot of our digital asset companies very quickly establishing regional headquarters here. So we're investors in businesses like Talos, which is headquartered in New York in the trading infrastructure space. Investors in businesses like Kiln in the staking space out of Paris, also kind of Singapore being the second office that they considered building, specifically because of that regulatory clarity. I think, ultimately, again, being realistic, the fintech ecosystem has definitely slowed down fairly significantly here over the last few years. There was a very significant deployment that was done in 2019, 2020, and up to 2021, where we haven't really seen that pick up again. And I think, frankly, probably healthy for the environment, right? Like we'd seen companies just raising too much capital, to the point that I made earlier of kind of recognizing the geography and the investor appetite and ultimately the exit environment that you face as a company here in Asia. Plowing in Silicon Valley style massive rounds actually has proven not really to work in most cases here. So I think that reset in the market is healthy. I think it also then leads to founders really thinking about what are the key problems that they're solving and ultimately where will the business drive value for the customer, right? Because I think, again, there are moments in time through hype cycles where definitely things are being built for the sake of building and capital is available, and we maybe see that a little bit more in the AI space today. But still really thinking about where does the value lie and what propositions are you building, and also recognizing that each market here in this region is very different. So I think another mistake, especially a lot of international companies made, was coming here and saying, Singapore is Asia, which obviously it very much isn't, right? So as you think about scaling in the region here, having specific propositions for Malaysia, Indonesia, the Philippines, Vietnam, if that's the direction of travel for the business, is very important and you can't be forgotten.
You raised an important point about the fact that, yes, investment has dried up. So you guys are investing in early stage startups to, I would say, growth stage. What are you guys actually looking at now in a company, if you're going to be quite specific, to actually throw some capital in and so on?
Yeah, so I think firstly we're a sector specialist investor, so we first start with our thesis around which sectors are we seeing the most capital investment and ultimately buyer demand coming from. And if you look at financial services, historically it's been one of the largest industries with spend on technology, and that's actually accelerating at the moment. So this year, somewhere around $600 billion is going to be the net new spend that a financial services industry spends on technology, and that's going up to over $1 trillion by 2029. A lot of that obviously driven by this new push of new infrastructure in AI, obviously. So we are going to be looking at, through the relationships that we have with our financial services partners, understanding where those budgets are being spent and what is the underlying tooling that's required to get to this new infrastructure refresh cycle. And as we look at that, then we look at what are the metrics that are required for it to be an interesting venture investment. So obviously large markets being a prerequisite, but also the bar in terms of current traction for a Series A business has changed quite significantly over the last couple of years. So really looking at businesses that have highly accelerated growth momentum and a view of continuing that trend over the next couple of years. And then finally, and I think this never changes, comes down to the team. Right? Who are the people leading this, leading the business? Why do they have a right to win? Why do they have this hunger to be quicker, faster, better than anyone else?
Awesome. So I'll get back to Zong now. So it's always good to be exit ready at some point once you're literally growing. So in terms of preparing for that and having that as an option, so we saw companies like Magnates early on, Magnates may be an exemption of an example, but how do you be or how do you encourage startups to be exit ready even from day one in terms of improving their governance, reporting standards, etc.? How do you advise them?
Yeah, I think it starts always with the team because I think you'll be very surprised as an early stage investor, most founders don't actually think about exiting the business. And which is where I typically start the conversation of venture funding is great, but it is typically a double-edged sword, right? Because I give you money, but you have to give me an exit as well, right? Because everybody is here to make money in this investment. And based on that, then you build on I would say the steps that they need. Basically, how do you build a company that has very little tech, almost no revenue, into a company that can raise funds from Illuminate, right? And then what questions do you need to answer? What sort of team? How do you build out your team, and how do you build out your product to actually deliver value, not just today, but also the next 3, 4, 5 years? And then being capital efficient, right? So while I think the seed rounds and pre-seed rounds here are definitely smaller than places like in Europe or in SF, but it's also a lot easier to be capital efficient here. So while you can raise less, you should be able to do more. So in practice, what we then do with our founders is to start getting them to think along that line, right? How does every decision you make today affect where you're going to land in the next 18, 24 months? And is that then in line with your 5, 6 year exit plan? And where are you planning to go by that point in time? And I think then it comes back to the biggest challenge that I think LPs have and sort of like news sites have around this region, which is where are the exits, right? I would say we are still quite an immature ecosystem, right? There are not a lot of serial founders. Most founders that we invest in are first-time founders. They have no idea what goes into actually building a business because most of them are techies. So they're very good at building products, they're very good at sales, but they have no idea what a balance sheet is, what an income statement is, and typically those are the things that are very easy to teach. So helping shape them from executors into actual sort of founders and visionaries is a very big bridge. Not many founders can make that jump. So at what point do you decide, okay, do you need a professional CEO to come in? Typically then do you need a CFO to come in, right? So how do you professionalize the management team to have the conversations, not just with the Series A investors, but the pre-IPO investors, and actually help you to actually achieve that goal of having an exit. So it's a lot, I said, across a lot of different parts of business building, but that's what we do with our founders, especially from the seed stage, to hopefully get them ready for an exit.
No, that's great. So let's look at I think what Luca mentioned as well was the investment winter that we're having now. So in terms of your perspective, what is actually constituting to the investment winter continuing? Do you see an end of the road? And you guys are, as mentioned, one of those guys that lead. So you like to take the risk and get the others to follow. Where do you see the investment winter heading? And is there like a turnaround around the corner somewhere?
For me? Or do you want to take for me? No. I think the answer to that question for me is very region specific. So the winter has been very much over in San Francisco for a while now. We are past peaks of 2020 and 2021, and I don't see signs of stopping for the time being. Right? We see is the top of the market. We were talking about it earlier with Tom around Anthropic, OpenAI, essentially unlimited private capital available to these businesses at the moment, and that also feeds the funds that are backing them. So, kind of 80% of capital raised in venture last year goes to basically a handful of firms that are chasing these massive outcomes, right? So, it's a bit of a strange environment that it's very kind of I guess a K-shaped type recovery even in the venture space, where if you're not one of the top companies, if you're not one of the top firms, you're finding a much more difficult operating environment, fundraising environment, which has trickled down to all of the smaller players. Here in Singapore, I haven't really seen the pickup just yet. Actually, I mean Q1 was not bad, right? I mentioned it. I think it was 2 to 2.5 billion raised here in Singapore, which again, kind of seeing a bit of a recovery. I think there was one $2 billion round though. So as always, these statistics, you have to kind of read the underlying data and see the health of the ecosystem. So I think to some extent, even here, you see this kind of disparity between the haves and the have-nots. And then you have a bit of a wave of the AI innovation ecosystem coming here into Singapore, primarily from China. I mean, you mentioned Manus earlier, a bit of a double-edged sword, right? Because have you seen the crackdown from the Chinese government on that sale? So will that was an initial spring, but let's see whether that can continue. But I think the reality is there are pockets of capital here. There is a lot of expertise, particularly in fintech, right? Being a very developed financial center, it's kind of why I think London became such an exciting hub to be investing in, particularly after the financial crisis. A lot of people with a lot of experience and ideas and networks and kind of a willingness to build. So in these times of kind of shake-up is when you see big new waves of innovation coming. So I think I'm always particularly excited about the opportunities in the region.
Yes, that's great. But on the same time, you're seeing a huge influx of funds into AI companies. And a question that is around is this trend ending? Where do you see on that? I'd like to get later Song's views on that. So we'll start with Luca.
I don't see an end to it just yet. I do think there will be fairly quickly a focus on unit economics coming to the fore. Even just as you see the big model companies moving away from all-you-can-eat pricing to more usage-based pricing, people are going to start recognizing that actually this workflow that I automated with Claude, which was only costing me $200 a month because it was doing everything, actually cost me $400 or $500 just for this specific workflow if it's usage-based. Then you realize, hey, actually this was, we had outsourced this to maybe a lower cost location where that can be someone's monthly salary in some places, right? So there's going to be much more of this, I think, kind of mental computation that needs to be done around what workflows does it actually make sense to automate versus not, and then that drives down to all of the individual companies and their ultimate unit economics and how they can then raise capital. So that's where maybe you start to see a little bit more scrutiny of the underlying numbers.
Zong, would you like to add to that?
Yeah, I think I've kind of accepted that it's not going to end. It's just going to change in different ways. I mean, last year, so on average, Cocoon sees about 2,100 deals a year in our pipeline. Last year, I think about every quarter was about 300 or so AI companies, right? So this first quarter alone, we saw about 450 odd decks from AI companies. So I don't think it's going to stop, but I think how it's applied, the innovations within the whole stack, that's what's going to change. I've come to accept that AI is probably going to be a permanent thing in our workflows going forward. So as an investor, then what we are looking for is genuine innovation within that stack. I'm not looking at wrappers, I'm not looking at app layers, because typically that's more consumer. We are more B2B, so I'm looking for that sort of second tier and maybe sort of more foundational sort of level of innovation or application, right? And then at the same time, in order to secure some value, how much of it can be patented, how much of it is trade secret. So how do you actually secure your future as a company when things are moving so fast? And, especially as they mentioned, right, Anthropic, OpenAI, they have endless cash, right? So how do you actually position yourself for that, right? Or are you competing at the data set level, right? So then I think it's important for us as investors to understand the actual ongoings within the space before you can actually make a dedicated decision. But I would say, yeah, it's definitely in a bubble at the moment, but that bubble is just gonna keep being around.
Interesting. So let's go back to Tom again. Let's look at three exchanges: SGX, Nasdaq, and then London Stock Exchange. So assume a growth stage tech company now wants to get listed. How would you look at it in terms of which exchange that they should look at? It's a bit controversial, but love
try
to
and
see
hide all
your
my
views.
biases. Look, I think actually picking up on the point there around AI, then also looking at just the dominance of very large companies within the US and how important index inclusion is in the US. The bottom of the S&P 500 is about $13 billion market cap. So when you say growth, I don't know what that means, but if it's not, especially as an international business, without sort of a core market of the US or that being, already having started there, I think the US for an international facing but Singapore founded business until you're really at that sort of scale can be really difficult. And that's not just from a issuer and story and noise perspective, but just the investor appetite. There's been people talk about outflows from public markets. In the US, the story is the outflow from actively managed funds. So the actual stock pickers out there, everything has shifted, pushing 70% now in terms of passive flows. So that, if you're not at that sort of 5-10 billion plus, I think looking at the US might be a little foolhardy, even if you were to tag on a listing into SGX for free. And that's also the costs around that. That's the scale of company. You have to compete with the litigation risk. The D&O insurance in the US alone will cost you the price of a listing in London or Singapore. Quarterly reporting, that you need to basically have a finance team big enough to deal with the push and push and push and push. You'll notice I'm talking about the exchange that isn't in the room necessarily in terms of where I'm sat in Singapore. Look, I think from a London perspective, I think London is very open to international businesses. Around about 36% of the businesses on our markets are international. Technology, we've got a good history with sort of platform technologies, fintech, and so on. The nice thing about London is that ability to scale up on market. You can come as a slightly earlier stage business, and we've had businesses that have been able to do. There was a business called Keyword Studios in the gaming sector, came as a £50 million market cap company, was bought out by EQT 6 years later at 2.8 billion valuation, was at 3 billion on market at one point, did 16 follow-on transactions in that stage. All of that to say, I think if you have a specific strategy, that roll-up strategy, or a way that you know that you'll be able to interact with investors as you grow, I think London is a great base for that. Look, I think Singapore's doing a lot. I think for a more solely regional local business, I think that can definitely make a lot of sense, and obviously has strengths in sort of regional industrials, REITs, and so on. So try to hide my biases, but that would sort of be how I approach it.
Awesome, guys. So I'll just now open the floor for any questions. Does anyone have a question? Okay, awesome. No questions. So then I'll just quickly touch. I think we've got about 10 minutes left. Let's go about, I think, what's quite obvious right now is the global crisis that is happening around. How do you see it impacting? So we'll start off with early stage and then move on to a bit more mature stage companies. So we'll start with Zong. How do you see that global environment impacting, I would say, funding, or how a startup would operate in that aspect?
Yeah, so I think for us as a fund, and for the startups that we invest in, I think on the enterprise tech side, most of them start off regionally. So objectively, while there's a lot happening in the world that's not too great, it doesn't impact the ability for our startups to at least go to market. Because a lot of what we're doing within the first 18, 24 months is proving, product market fit, scaling your revenue, and at least getting to a point where you can make the decision, do you want to go global? And if you're going global, are you going to the GCC, or are you going to the US, you're going to Africa, LATAM, whatever it is. So on the enterprise tech side, it doesn't impact our ability to do deals or help the companies scale. On the deep tech side, I think that's when it gets a little bit more picky, right? Because in the deep tech side, we have material sciences companies, we have med tech companies as well, and typically that's when you start to have the conversations about the geopolitical tensions, right? Are you serving the Chinese market? Are you serving the US market? Do you need to choose one? Can you do both? Or is there inability to do both, right? So it's about helping the founders understand that to a certain point, your product can be the best in the world, but then, the powers that be will also have a say in where you're going to be or how you're going to be able to sell. So it's helping them realize that conversation and then making the best educated decision we can at that point in time before we start scaling. So to come back to your question, at the early stage, thankfully, whatever's going on around the world hasn't impacted our ability to do business, nor our startups as well.
That's interesting. I'll just add a quick lead on. So now with the situation mainly in the Middle East getting a bit jittery, where do you see Southeast Asia stand out? Because now we can consider SEA to be a bit more, or a lot more safer, secure, and so on. Where does the standing there, Luca, come in?
Yeah, I mean, I think a bit similarly, the situation in the Middle East at the early stage hasn't really had any major or significant impact on early stage investments so far, right, that we've seen. Maybe a bit of kind of flight of capital from the region to places like here in Singapore. I don't think that necessarily also impacts the early stage investment ecosystem. I think the main thing that at the early stage, we're contending with, as well as a lot of the financial institutions that we work with, and I presume a lot of the corporations represented here today, is more around the arms race on AI foundational models. Like that is definitely something we're looking at very closely, and we see, even at the very large institutional level, banks wanting to host models in-house versus having kind of any vendor reliance, even to US companies like Anthropic or OpenAI. So they'll bring in open source models, and most of them come out of research labs in China. But you have to obviously balance that with security risks, with ultimately geopolitical risks, with what happens when some transactions get blocked, as we've seen with Manas. So when we've made a few investments in Hong Kong, for example, we have to consider what happens if the capital can't be taken out later on once there's an exit. So for I think a lot of early stage investors and technology investors, that is a lot more front of mind at the moment than ultimately the price of oil and what's happening in the Middle East. The spillover effects there, I'm sure, will be significant if things aren't resolved relatively quickly, but so far, not a lot.
From a listing point of view?
Look, I think IPOs always rely on a bit of stability and less volatility. There's no denying that we've seen quite publicly a business called Love Holidays, which was due to IPO in Q1. They've delayed that. I think something, I don't know the exact percentage, but a large percentage of their revenues was from holidays in Dubai, which obviously made it a little bit more difficult. I think more broadly, actually, though, activity in the secondary market in particular has been really strong, and a lot of businesses that are clear on how they handle that or don't have a touch point there have been quite confident to go back to market and raise capital. We saw Seraphim Space Trust, which actually does a lot of private investments, raised 140 million pounds on the London markets last week, and IQE in the sort of wafer space, 80 million. So a lot of capital still there and willing to invest. So that's not been as affected on the secondary side, but IPOs, a bit more wait and see. But I still think it feels like a bit of a new normal where we've had, I don't know how many more years you go back, but there's always something. So I think more willingness to sort of say, hey, we still have to do this and just might need to think about it a little bit longer. I think from the more sort of geopolitics more broadly, I think an advantage of both Singapore and the UK is in some instances seen as quite useful. We had a Chinese bond list in London at the beginning of the year. And we've had US firms, and we had a US firm list a couple of months ago as well. So we're seen as relatively neutral, and I think it's more about then the investors' decisions as to which they back. In things like the resources sector, crucial to a lot of that AI development and so on, we do see different stories coming with different approaches. Some that will say we are a supply chain that is all ex-China, and some say, no, we won't, because they've been doing it for years and that's the place to do it. And then it just becomes about the investors' appetite and their decision.
Awesome, guys. So I think we'll just wrap it up here. So before we close, we'll just give a few seconds to each panelist again. As a closing note, what would you leave with the audience today? A couple of key points.
I think from the investor point of view, I think there's a lot of value still to be found in startups in this region if you're looking to invest as an angel or if you represent a fund. And I think it is basically making sure that you ask the right questions, which then tallies into the recommendation for the operator side of things, where I think the funding winter is definitely exaggerated because it is just an easy excuse to get catchy headlines, right? But what I think is that there is a larger focus on the fundamentals. So things like your margins, things like your revenue. So we're past the days of the whole GMV wave. Right now it's about your profit margins, your gross margins, and how does that scale with where you want to go. So I think both as an investor and as an operator, think along those lines, and I think that will set you up quite nicely to handle whatever that's happening, not just in the world, but also this region.
Yeah, I mean, I think given all the firms represented here, if I was running a trading organization or a financial services institution, this is probably one of the most exciting times to be witnessing this very, very rapid technological change, which the flip side of that is that it could also be quite terrifying because ultimately the underlying operating model, the underlying technological model is going to change very significantly for most firms over the next 2-3 years. And I think if organizations today aren't ready, aren't engaging, aren't trialing, aren't thinking about the cultural change that's required in organizations to move into a much more kind of agentic future, you're going to be left behind. So do spend time with all of the innovation and kind of all of the earlier stage companies that are here, and also engage with early stage investors who have fingers on the pulse in the ecosystem.
I think sort of trying to bring some of this together. Look, Singapore's done a fantastic job of that early stage funding and is expanding that over time. And I think to a lot of the points that Zong made earlier, whichever platform you might choose for exit, need not be an IPO, by the way, it could be a trade sale and so on. With everything going on around in the world, it's vital that you just are prepared for that, both from an internal corporate governance perspective, but also your story and how you meet all those global challenges as well. Yeah, I think I'll leave it there.
Awesome, guys. So a huge thanks to our panelists, Tom, Luca, and Zong for being here, and to the audience for this session. Hope it was quite useful. We managed to pass on some critical pieces of information from going from pre-seed to exit, covering the whole life cycle of capital, and hopefully you guys would look at Singapore as an entry as well as other markets as an exit. So have a great day, and thanks again for joining this session.